In this video, we're going to talk about Bionano Genomics, trading under the ticker symbol Bngo. Bionano Genomics is a startup operating in the genomics sector and has been a popular stock to pick and a topic of conversation ever since late 2020, after the company managed to develop tests that were better and more affordable than its rivals. This was mentioned in the scientific magazines and picked up by ARK Invest, managed by Cathie Wood. This was a really major event for the stock because it attracted the attention of retail traders. Its appeal is the fact that Bionano Genomics seems to have a lead on this sector, and the sector itself is considered to be on the road of becoming a lot more significant in the years to come. The trading volume of Bionano Genomics has recently been 6.9 million shares, compared to an average volume of 8.5 million shares. Over the previous 52-week period, its price fluctuated between $2.43 and $15.69. The market cap of Bionano Genomics is currently at $737 million, compared to an enterprise value of $1.2 billion. The difference between the market cap and its enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. Some of the examples of the impact by leverage is if the company has a lot of debt, then the market may feel uncertain about the company's capacity to pay back its interest and principals, which may then negatively impact the profitability and solvency of the company. Another key element to understand is the asset composition of many companies, and this is particularly true for growth-type stocks. For many of them, one of the most significant assets they own is called goodwill. Goodwill is basically an expectation of the market that the company is able to generate more profit or to have more growth than another company, partially because it has a good management, stronger brand recognition, bigger following online, and so on. In other words, it's not a tangible asset that companies may use, but it is often the reason why companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, which is the value market gives to its assets when the debts are paid off. In comparison to its historical price fluctuations, the stock is 4.9% higher than the 1-month low, 4.9% higher than the 3-month low, and 4.9% higher than the 52-week low. Regarding the options market, which often gives a hint on the market sentiment regarding where the stock price is likely going to head toward, the implied volatility is 108% compared to a historical volatility of 70.4%. The put-call volume ratio is currently at 0.3. The most recent volume of options traded has been 4.6 thousand contracts within a day, compared to the 30-day average volume of 5.1 thousand. In terms of open interest, the most recent volume of open interest has been 158,000 contracts, compared to a 30-day average of 163,000 contracts. In terms of the shareholder structure, institutional shareholders hold 27.4% of its outstanding shares. The biggest shareholders include BlackRock, Vanguard, and State Street Corp. The relevance of the shareholder structure is important to determine whether you should be holding the stock long-term or to view it as a short-term trade. If the stock is mainly held by retail traders, then it is a sign that the stock may lack the depth to justify long-term holding. Of course, there are a lot of exceptions from what I said above, but usually the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. Let's also look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes, if there are significant short interest in the total volume, it could be a sign that there is an organized shorting operation going on, like what has been going on with GameStop and AMC. The current short interest is 14.3% of the total float and 56.2% of the dark pool transactions. Now, let's take a look at the indicators. Financial indicators give us a suggestion of what the price movements are showing, and they can be used as one of the elements to determine what should be our overall approach. The moving averages of the past price actions show 14 sell, 1 neutral, and 0 buy, with a tendency of strong sell. In terms of pivot points, which are levels of support and resistance sprinkled in the price trends, the support levels are $2.15, $2.59, and $2.86. For the resistance levels, they are $3.72, $4.45, and $5.60. Looking at Bionano Genomics operations, fundamentally, the news have been positive and bullish for the company. On December 29th, Bionano Genomics published an article stating that they have developed a prototype for their single molecule imaging system. This system is 4 times more powerful than the Sapphire system. The commercial release of this prototype is planned for 2023, which should also act as an additional catalyst for Bngo. Market participants are attracted by the company because its technology and business model seem to be head and shoulders above its competitors, and it has a very high brand recognition. This is why I think that the market participants are often willing to give it a chance to believe that it can succeed as soon as there are encouraging signs that the company is doing well. Right now, the company has good technologies, which is one of the reasons why, despite the recent sloppy price action, I think that the stock is worth to take a look at and to be taken on a short list. My opinion on the company remains overall bullish, or at least worthy of your time, and that it deserves to remain on your watch list and eventually in your portfolio if you are future-oriented or has high risk tolerance. With that being said, even though many would argue that the future belongs to healthcare, energy storage, and electric vehicles, in other words, the hot stocks back in 2020, keep in mind that the future may occur a very long time from now, and that in the meantime, you gotta make sure that the portfolio is hedged against that kind of risk of medium-term volatility. With the downward trend resuming in late 2021, I believe that it would continue for some time as we move in 2022, so it's definitely something to keep in mind. This can explain why investors have been looking elsewhere from the popular stocks of 2020. For example, in 2021 and now in 2022, they may be looking into blue chip stock, fixed income, and short squeeze stocks. My recommendation is to make sure that your exposure on Bionano Genomics remains at a maximum of 0.5 to 1% of your portfolio, and to look for other potential support levels to enter in the trade. I would say that the previous peaks over the past few months is a good place to start looking for initial profit targets. Your investment should also take into consideration the market conditions and the surrounding sentiment to determine what kind of asset should be picked, for how much and for how long. First of all, the financial market doesn't reflect the real economy. If the stock market is doing great, it doesn't necessarily mean that companies are hiring people, that salaries and living standards are rising. Sometimes it's the exact opposite that happens, because the stock market is a pool of money where things come in and come out, going to different sectors to be placed. The capital may be used to be invested in a company to improve its efficiency and productivity, but it can also be used to buy up shares and assets in order to make a profit. This phenomenon is called financialization, and it means that the more money is being used for non-productive purposes like merger and acquisitions, fees to financial sectors, buying back equity, and so on, the less there is for the real economy. Another way to put it is that ever since 2008, the Dow Jones has increased significantly. But people don't necessarily see this growth in tangible ways. This is why we gotta be careful with the assumptions that rising stock price means better outlook for the company. Sometimes it doesn't mean anything other than the fact that the asset is getting more expensive to be bought and that their yields is going down as a result. Additionally, some new phenomenons are now palpable, such as the creation of new bubbles, the participation and influence of retail traders in specific situations, and the anticipation of a massive recession or at least pullback. Bubbles have always been created on and off over the past few centuries, but nowadays it's quite interesting to see the speed at which an organic bubble can be created back in 2020. Because almost immediately after the major collapse of the financial market back in early 2020, the market decided to pour a massive amount of capital in the EV sector and anything that's related to it. Stock prices went up the sky, and for a moment, it really felt like any EV stock can be a golden goose. Another way to say this is that any SPAC with an EV company in it will become the next Tesla, right? Even if it didn't last that long, this episode definitely allowed the market participants to park a lot of their money in a sector, leaving it with either a lot of profits or at least avoiding incurring large losses because they left their money in the blue chips or the sectors heavily affected. The involvement of retail traders in companies has also been much more pronounced in recent months, especially in the scenarios of a short squeeze. Companies may have short sellers who believe that the stock will decrease in value. The short squeeze consists of buying the stock price up to force the short sellers to recover their positions, which will then also trigger an even bigger increase of stock price as a result. Of course, I'm not saying that this is always rational. I'm not even saying that those companies always have a convincing narrative. So, for example, if you play video games, ask yourself if you personally bought all your games at GameStop, knowing that you can buy the same games just online in the comfort of your home. But nevertheless, retail traders do have a much more significant influence in the stock price nowadays, for the better or worse. Personally, I think that as long as the volatility is high or gets higher, it'll create more opportunities. The final phenomenon is the anticipation of a recession. Many people have been expecting something of that sort to happen ever since 2008. There were quite a few companies that were supposed to go bankrupt because their debt structure is no longer sustainable or that their business model is bad. But overall, the system was able to hold its ground, especially in the North American market. This is partially because capital around the world often choose to come to the American capital market when things get heated back home. This is especially the case when geopolitical tensions increase around the world. In order to make sure that capital can provide a steady return without being affected too much by the central bank policies and inflations, I think that this phenomenon will increase its pace as time passes by, at least for the next couple of years. This is why we will likely see the blue chips continuing their ascension, even if for the growth stocks, things may be a lot more nuanced. The bottom line in all this is that the environment is getting more uncertain and volatile in a context where asset yields will probably remain quite low, because the real economy cannot be improved with just money. As far as we're concerned, this means that the patience would be a great virtue for all of us, and that there will be plenty of opportunities to eye for better prices. With that being said, always make sure to keep your positions diversified and keep the risk level under check. Speculative positions should play a small part in your overall portfolio. I would say it's better to keep them below 10 to 20% of your total holdings. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.